All right, let's break down a hot topic that's on everyone's mind: inflation and how it's jacking up the interest rates. Now, I know this is shocking, but a 30-year mortgage in the US has just hit a whopping 7.4%. That's a number we have not seen since way back in December 1st, 2000. Okay, so now from where we're standing, things are looking pretty grim. Everyone's scratching their heads and they're trying to figure out how the markets are going to hold steady under this kind of pressure. Now, so what has kicked off as a small problem has really blown up into a massive financial storm, one of the biggest asset bubbles we've ever seen. So you might be asking, hey, what is the backstory here? So understanding how we arrived at this point is key to seeing what lies ahead. All right, and I'm going to tell you, there are some major warning signs that are flashing about the state of our shaky economy. Now, we're staring down the barrel of a housing crash that could be the most devastating one yet. Now, to really grasp why today's situation is so out of the ordinary, we're going to jump in our time machine, take a quick look at history. So we're going to dig up some crystal clear evidence proving that what's happening right now is anything but business as usual. Stay tuned as we dive into the past to uncover the truth behind today's economic turbulence. Okay, so we're going to check out this chart and we're hoping that this will help you to understand. Now, a lot of times people will show you a chart like this and it's all about the history of housing prices. But there's a big problem with most of these charts. They forget about something super important, and that is inflation. Okay, so what's the big deal with inflation? Well, it's a game changer over a long time, like 40 or 50 years. Inflation is like the invisible force that can make the past seem cheaper than it really was. So for example, if someone tells you, I bought my house in 1998 for $220,000, you might think they got a great deal. But hold on a second. That $220,000 back in 1998 is actually worth a lot more now in 2024. It's like having $367,000. So that means even though it looks like they've made money on their house, it's not exactly true when you consider inflation. So if we really want to understand if there's a housing bubble, we've got to factor in inflation. And we want to see how much the house prices have truly gone up. And for that, we use something called the inflation-adjusted CaseShiller index. Now don't worry, I'm not going to put you to sleep with the details on that, but this index shows us the real deal about home prices. It takes away the trick of thinking prices are just going up because the dollar's value is going down. Now, when we look at this updated chart, it's going to be pretty clear to you we've actually gone past the last big housing bubble, which was a huge deal in U.S. history. Okay, so let's dive in and see what this really means for home prices and if they're overpriced right now. You remember 2008? Houses were selling for prices that blew everybody's mind, right? People thought those prices were off the charts, and they kind of were. But here's the thing. Over the last century, we've seen house prices steadily go up. That's normal, yet what's happening right now is anything but normal. So since around 2012, things have taken a wild turn. We've shot past what we used to think as normal prices, and believe it or not, today's housing bubble is even bigger than the one in 2008. That's right, it's going to get worse. Now you might be wondering, why do I think prices are going to drop? Well, there's a point in this whole discussion where those who are super optimistic about house prices, the ones we call bulls, kind of run out of steam. Now, they can't really argue against the possibility of a crash anymore. So now I want to break down why the housing market might be heading for a tumble and what that means for everyone looking to buy or sell a home. Okay, in order to do that, we're going to rewind to the year 2000. Now, if you're a history buff, you might not be too shocked to hear that the seeds for the 2008 crisis were already being sown back then. Now, you might be asking why. Well, it all comes down to interest rates. You see, historically, interest rates were pretty high, especially compared to what we're used to now. But over the last 30 years, there's been a steady drop in those rates. Now, this might sound like a good thing, but it'll actually set the stage for the 2008 bubble to inflate and eventually pop. But here's the kicker, right? We didn't really learn our lesson. After the bubble burst in 2008, the Federal Reserve went on to slash interest rates even further, hitting a low of 2.6%. And guess what? This sparked a whole new bubble. From the late 2011 all the way up to the present, the real price of home, that's the price adjusted for inflation, shot up by 66%. That is a huge jump. And outside of the 2008 spike, it's something the country has never really seen before. Now, history has shown us that every time there's a rapid rise like this, a crash usually follows to balance things out and bring prices back to the historical average. All right, so what does this all mean for us? All right, what's going to happen? Well, it's a reminder that what goes up must come down, especially in the housing market. Now, I remember I bought my current home and a bunch of my rental properties back in 2009, 2010. And on my home, I did get a really good interest rate. I got 2.875. So I took advantage of the home prices when they fell and the interest rate when it was low. All right, let's get to the good stuff. You've probably seen charts and graphs that try to explain the housing market, but sometimes they leave you wanting more, right? Well, hold on to your seats because we're going to get something that might just be a game changer. It's the proverbial nail in the coffin for any doubts you might have. You might be asking, what's this all about? And it's all tied to interest rates and how they influence the housing market. So most home buyers and investors, they get into the game with a loan, typically like a 30-year fixed mortgage. Now, without getting too technical on you, the 30-year fixed mortgage rate is closely linked to the 10-year treasury. That's right. This financial tool is a big deal because it sets the stage for mortgage rates. Now, you might be wondering, what does this have to do with the value of my home? Well, that's exactly what we're about to reveal to you. Imagine a 10-year treasury note as a fancy IOU from Uncle Sam. It's pretty straightforward, really. You lend the government some cash, and they promise to pay you back in a decade with a little extra for your troubles, to the tune of 4.5% interest. But hold on to your wallets, because here's where we hit a financial plot twist. There's also this thing called a 2-year treasury note. And get this, it's offering 4.64% interest rate. That's higher than the 10-year note, which is kind of like the finance world going topsy-turvy, because normally the longer the loan, the heftier the interest should be. So when short-term rates outdo long-term rates, we're looking at what the money gurus call an inverted yield curve. And if financial forecasts were weather reports, an inverted yield curve would be predicting a storm, a recession storm, that is. So if you look at history, it tells us that when you see this curve flip-flop, it's time to batten down the hatches because the chances of a recession are sky high. So we're looking at this chart, and it's like a crystal ball for recessions. This bad boy dates even back to the late 70s. It's got an almost spooky track record. Every time the line clips below zero, a move that's known as an inversion, a recession is followed. It happened in the early 80s, early 90s, early 2000s, and the big one in 2008, and even in 2020. Okay, so let's zoom in on this drama that's going on. This chart shows you what is coming. We've gone deeper into the inversion and are just starting to claw our way back up. So you might be thinking, hey, we're heading up. That's got to be good news, right? But hold on to your wallets, Because in the world of economics, the real trouble often starts after the inversion fixes itself and the line climbs back into the positive territory. If you remember 2008, the real pain didn't hit until years after the inversion. Now here's where it gets super interesting. The Fed is hiking up the interest rates trying to play it cool, but the bond market isn't falling for it. And here's the kicker. The 30-year yield is practically mirroring the 10-year yield, which is like the market whispering, or maybe shouting in this case, that inflation could be coming to crash our party. So you might be saying, hey, why does this matter to me? Well, because if the 30-year rate was really tempting, everyone would be snatching up those 30-year treasuries, but they're not. And that's because there's a whole lot of uncertainty about what the next few years are going to look like. So you've heard about the 10-year treasury note, right? And here's the deal. Investors can get the same yield from a 10-year note as they can from a 30-year one, which is kind of crazy. To sell those 10-year notes, there's got to be a sweetener, an incentive that makes you say, wow. And right now, that wow factor is a rate that's looking pretty outlandish next to the 30-year. Now, if this part's got you scratching your head, don't sweat it. The main takeaway is that these treasury yields are like a fortune teller's crystal ball, hinting that high inflation might stick around. And if inflation stays high, the Fed will keep raising the rates to try to tame it. But here's where the twist comes in. To get inflation to rear its ugly head again, the Fed would have to throw in the towel, and that usually means we're in a crisis mode. And folks, I'm going to tell you, the crisis is staring us right in the face, the potential collapse of the housing market. Interest rates are like gravity. We're stepping into uncharted space. If something snaps, it could send the whole house of cards that we've been building since 2012 tumbling down. And that bubble that we thought was huge before, it's going to look like a tiny soap bubble in comparison. So, how does this housing market hiccup hit home for you and me? It's not just about rising interest rates or the economy hitting a speed bump. For homeowners, higher rates mean those with adjustable rate mortgages or those looking to refinance could be facing steeper monthly payments. Or even look at all those homeowners that want to buy new homes and they'll have the higher interest rates. This could lead to more homes being foreclosed and sold for less than a car. And for the investors out there betting on property values climbing forever, there's a storm brewing. They could find themselves with properties that are worth less than the mortgage and collecting less rent to boot. Now remember, there's always opportunity when things go down. I bought a lot of properties in 2009 and 2010. That's when I bought the house I live in. So if you have the ability to buy houses when the values go down, you need to take advantage of it. Okay, hopefully you found this video helpful. Give it a thumbs up and hit the subscribe button for more videos on wealth building and making money. Let us know your thoughts in the comments section.